Yo, what's up guys? In this video, we're actually going to be analyzing Perion network stock and also FuboTV. I hear that one talked about on YouTube a bunch, so we're going to be analyzing both of them from a pure financial point of view. And both of these stocks are actually at that all-time low or 52-week low level, which is really unfortunate. But we're going to be analyzing them, and I'm going to be showing you the real important metrics you actually want to be looking at for these really tiny growth stocks. Both of these market caps are under $600 million. Like Perion Network is 571, and as you know, the stock price is not good. And Fubo, this one's a $383 million market cap stock, and it's basically at all-time lows, which is really unfortunate. So we're actually going to be analyzing both of these from a pure financial point of view. We're going to start with Perion Network because I own this one. I actually don't own any shares of FuboTV. Remember, none of this video is financial advice, and let's just get straight into it. And if you would drop a like on the video, it would mean a lot for me, but we can kind of already guess why Perion Network has fallen because of this net income or EPS decline of 50%. But guess what? It's not terrible because this company is still completely debt-free. I want to show you the highlights. So even though they actually just lost a contract with Microsoft, and I knew about this news before they lost it, I thought it was already priced in, but it wasn't. So the diluted weighted average shares, you actually have not been diluted at all as a shareholder, or only 0.5 or 0.15%. But most importantly, remember the market cap on this company. It was $600 million. Well, guess what? Their cash position is up 31% year over year without having to take out debt or issue shares. You know, this is all organic cash that they've just been keeping up. And guess what? This $174 million of cash is making them an interest, or at least in the most recent quarter, $5.49 million. And honestly, they really need this money. They also announced they're going to be buying back $50 million worth of shares. And if you compare that to the market cap, 50 million is actually a significant amount. You know, that's like 8% of the entire company they're buying back. Yeah, so they have under a $600 million market cap at 571 million. But if you look on the left here, they're actually trading at a PE ratio right now of 5.63 and a forward PE ratio of 4.39. That is so cheap, but also it's because the growth is really stalled here. All right, guys, now we're actually going to be going through the Perion Network investor presentation just to see what they do if you don't already know. They're really in the advertising space, and they actually own all of these companies right here. Hivestack is a very quality company. I think they got a steal when they bought this company, but actually they reach people all throughout the day from 7 a.m. to 7 p.m. But actually, since they lost their contract with Microsoft, they've been focusing on some of their smaller avenues of growth, like the retail media. It's growing 134% because you're really comparing from small numbers, but it's still really good to see that they're focusing on this and actually growing it. They have the ability to do that. The CTV growth grew 108%, and the digital out of home grew 25%. So let's actually look through these growth together. This is the retail media solutions. Look at the growth that they've had, and this is the CTV advertising, and you can kind of see all the companies that have advertised with them, from ESPN to Kroger. You know, these are all very popular stocks. You know, a lot of these companies are public. And then the digital out-of-home advertising market looks like we got a Lululemon, digital display out there, which grew 25%, which is pretty cool, from 7.7 million to 9.7 million. And it looks like they actually have a case study for their Lululemon billboard that they had. You can actually click and watch the video. We're not going to do that, but I want to show you some other things. I guess they also own this, an AI-based audience segments for cookieless future. So, if you know what cookies are. And they also own Wave, which is a generative AI-driven audio ad. So that's pretty cool. So if you have an ad you have in English, you can, translate it to Spanish and put it on these radio stations or whatever. But let's actually check out their financial outlook, because that's kind of what we want to be looking at. So here is actually their net cash. Remember, we thought it was 171 million. I guess they're saying it's 479 million, which if you compare that to the market cap, that's really high. But we really want to come down here to the full year 2024 outlook. And the adjusted EBITDA is what we want to look at, because we also can do a multiple on the adjusted EBITDA, which honestly puts them in a prime position to be bought out by a company for a very reasonable price. So if we assume $82 million of adjusted EBITDA and compare that right now to the $571 million market cap, they're trading right now at a just under 7 times adjusted EBITDA. So this company could easily be bought out for 8 or 9 times adjusted EBITDA, or it's in a prime spot to be bought out, just my opinion. Now let's actually dig into into FuboTV stock though. All right, guys, so now we're going to be analyzing FuboTV stock, ticker symbol FUBO. Now, they actually make a product slash service that a lot of people really like. We can see that by going to their total revenue, which is up 24% year over year. This is actually a very impressive total revenue growth. I mean, look at this. In 2019, it was nothing. It's literally zero, and now it's 402 million just since 2019. But if we head over to their net income, now this company has always lost money, but if we head in the most recent quarters, see this green number at the bottom, that's the year over year growth. So they're actually losing less money than they were. And we can actually verify that by going to their EPS, which is right here, which is up 49%, or they lost 49% less than they did, as you can obviously see. All right, so here's their balance sheet, which actually doesn't look great. You actually own a little less equity in the company. It went from 66% to 79%. So that means their liabilities are catching up to their assets, which isn't great. But if we head over, here's their operating cash flow. Look at the green number at the bottom, the year over year comparisons. It's actually very good if we compare it year over year. And I also think this is important. It's a little thing to be keeping aware of if you're a shareholder. They're actually at the lowest amount of cash I believe they've ever had, or, since 2019. So $165 million of cash right now. And their debt is actually $387 million. So they do have more debt than cash, but it's not a crazy big deal because they're growing their subscribers like crazy. All right, so this part right here, I'm actually going to need a little bit of help in the comments because I don't know if this is real. I actually just discovered this right now. So look, their total common shares outstanding are up 6.44%. So that means you've been diluted 6.44%, which isn't that big of a deal if it was only 6.44% because they're growing like crazy, way faster than 6%. But if we go to their diluted weighted average shares, which I'll show you the definition of this from ChatGPT in a second, you've actually been diluted 32% year over year. We can kind of see the total amount of shares outstanding. And if you're wondering, what is this metric? Because I always look at the total common shares outstanding. I just asked you ChatGPT this or Gemini, and this is what they told me. And basically, it does not include, so total common shares outstanding does not include things like stock options, convertible debt, where people and employees and insiders can buy into the company later if they wanted to. So I actually like to look at this metric more importantly than total common shares outstanding. So let me know if you give any importance to this metric, or maybe I'm looking at this wrong, but you actually have been diluted 32% year over year and 5 million new shares in the most recent quarter. But I think if they can stop right here, they're in a position right now where they probably don't need to dilute anymore because they're losing less and less money. And they have about 3 or 4 quarters left of cash before they completely run out. So we got 2 or 3 more quarters of cash. Remember, guys, I'm definitely no expert. Please drop a like on the video. That was kind of my analysis. Not financial advice, nothing in this video. But if you would leave a comment, I will respond to every single one of them. But I hope you guys have a fantastic rest of your day. My name is Nathan Robert.